San Rafael, California, March 1956. Two men are sitting at a folding table in a small apartment. One is an engineer, one is a mathematician. Between them, a yellow legal pad, a half-empty coffee pot, and an idea that, within 40 years, will quietly decide whether you can rent an apartment, buy a car, or get a job. They called their company Fair Isaac, and what they built that year, what we now call the credit score, was designed with a specific purpose. Not to help you. To help the people lending you money. Here's the 1956 blueprint, and once you see it, you cannot unsee it. Right now in 2026, there is a 3-digit number following you everywhere you go. It decides the interest rate on your mortgage, your car payment, whether your landlord approves your application. In some states, it influences what you pay for car insurance. In some industries, your employer can check it before they hire you. One number, built on a formula invented by two men in a California apartment 70 years ago. According to the Federal Reserve Bank of New York, Americans are carrying $277 trillion in credit card debt as of the fourth quarter of 2025. That is the highest balance recorded since the Fed began tracking this data in 1999. And here's the number that should stop you cold. A person carrying the average revolving balance today, making only minimum payments, will spend 22 years paying it off, and hand over roughly $18,500 in interest alone. That is according to NerdWallet's 2026 household debt analysis. But how exactly does a scoring system built for banks in 1956 still control your financial life in 2026? How did it get this much power? And more importantly, once you understand how it actually works, what can you do about it? Not someday. Today. The archaeology begins here. To understand why the credit score was created, you have to understand what it replaced. Before 1956, getting a loan in America was a profoundly personal and profoundly unequal transaction. You walked into a bank. A loan officer looked at you. He assessed your clothes, your handshake, your neighborhood, your name. He might have known your family. He might have known your church. And on the basis of these entirely subjective impressions, he decided whether you were creditworthy. The historical record of this era is unambiguous. According to a 1992 legal study documented in NYU's Review of Law and Social Change, loan officers in pre-FICO America operated with near total discretion, and that discretion was routinely exercised along racial, gender, and class lines. Black applicants, women, immigrants, and people from certain zip codes were routinely denied credit regardless of their actual financial behavior. The system was, as one historian described it, a blacklist of people lenders didn't like. And then there were the early credit bureaus, private companies that collected information on individuals' personal lives to sell to lenders. The retail credit company, which you know today as Equifax, was keeping files in Atlanta, Georgia that, according to the historical record, included details about people's personal lives, their political opinions, their medical histories, and their private reputations. This is not speculation. Congressional hearings in 1970 examined this practice directly and described the files as deeply invasive. This is the world Bill Fair and Earl Isaac looked at in 1956, a chaotic, personality-driven system where the same financial behavior could get one person approved and another rejected, based entirely on who was sitting behind the desk. Their solution was radical for the time. Replace the loan officer's gut feeling with mathematics. In a few minutes, I'll show you exactly what that mathematics measures. And when you see it, you'll understand why the system that was supposed to remove bias ended up encoding a different kind of trap entirely. Bill Fair was an engineer. Earl Isaac was a mathematician. They met while working at the Stanford Research Institute in Menlo Park, California, one of the most significant applied research institutions in post-war America. What they saw every day was the power of operations research, the discipline of using mathematical models to solve complex, real-world problems. It had been used to optimize military logistics in World War II. It was transforming manufacturing, and Fair and Isaac believed it could transform lending. According to FICO's own corporate history, they left Stanford Research Institute in 1956 and founded Fair, Isaac & Company with a combined investment of $800. Their first office was a studio apartment in San Rafael, California. Their founding thesis, stated explicitly in their early business documents, was that data used intelligently could improve business decisions, and that this intelligence could be reduced to an algorithm. They wrote letters to 50 of America's largest consumer finance companies, offering to build them a credit scoring system. 49 did not respond. One did. That single response kept the company alive. And 2 years later, in 1958, Fair, Isaac delivered their first scoring model, called Credit Application Scoring Algorithms, to a consumer finance company. It was the first time in American history that the decision to extend credit was based not on a banker's impression, but on a mathematical analysis of past financial behavior. It was a genuine innovation. It was also, from the very first day, a tool designed and sold exclusively to lenders, not to the people being scored. The consumer never saw the formula, never knew their number, never had a say in what the algorithm measured or how it weighted their life. I want you to sit with that for a moment. A private company founded in a California apartment created a formula that would eventually govern your ability to build a life. And the people it was built to evaluate were never consulted, never informed, and never given access to the rules. Through the 1960s and 1970s, Fair Isaac worked quietly with banks, retailers, and credit card companies. They built custom scoring systems for Montgomery Ward in 1963. They worked with Wells Fargo and Connecticut Bank and Trust in the 1970s. The algorithm spread through the American financial system like a slow, invisible tide, replacing human judgment, one lender at a time. Then, in 1989, Fair Isaac did something that changed everything. They released a standardized, general-purpose FICO score, one number, one formula, available to all three of the major credit bureaus, Equifax, Experian, and TransUnion. For the first time, a single private company's algorithm was simultaneously in use at every major credit bureau in the United States. But the system didn't become truly inescapable until 1995. That year, Fannie Mae and Freddie Mac, the two government-sponsored enterprises that underwrite the majority of American mortgages, formally adopted the FICO score as a requirement for all conforming mortgage loans. According to FICO's own documentation, this was the inflection point. After 1995, if you wanted to buy a home in America, you needed a FICO score, not a recommendation, not a character reference, a 3-digit number produced by one company's proprietary algorithm. Washington, D.C., the early 2000s. A mortgage broker sits across from a young couple buying their first home. He pulls their credit report. He has their FICO score. He quotes them an interest rate. They nod and sign. Neither of them, not the couple, not the broker, fully understands the 5-part formula that produced the number that just cost them, or saved them, tens of thousands of dollars over the life of that loan. This is the mechanism. And once you see it clearly, you will never look at a credit card statement the same way again. Imagine you're a bank. You're about to lend someone $50,000. You want to know, will they pay me back? You can't read minds, but you can look at history. Have they paid their bills on time before? Do they currently owe a lot of money compared to their credit limits? How long have they been managing credit accounts? Have they recently applied for a lot of new credit, which might signal desperation? And do they have a mix of different kinds of credit or just one type? That's the entire model. 5 questions. One number between 300 and 850. According to FICO's publicly documented scoring methodology, the 5 factors and their exact weights are payment history, 35%. Amounts owed, also called credit utilization, 30%. Length of credit history, 15%. New credit, 10%. Credit mix, 10%. That 35% for payment history is straightforward. Pay your bills on time. That part makes intuitive sense. But the 30% for amounts owed, this is where the system reveals its logic and its peculiarity. The formula doesn't measure how much debt you have. It measures your credit utilization ratio, how much of your available credit you're currently using. If you have a $10,000 credit limit and carry a $3,000 balance, your utilization is 30%. Below 30% is considered good. Below 10% is considered excellent. Here is the counterintuitive part that almost no one talks about. The system rewards you for having high credit limits, even if you never use them. Requesting a credit limit increase, without spending a dollar more, mechanically improves your credit score by lowering that utilization ratio. This is not a loophole. It is the intended design. And ask yourself, who benefits when Americans carry higher credit limits? Think about your own credit cards for a moment. Have you ever paid off a loan and watched your score drop? Have you ever canceled a card you never use and found your score fell? Have you ever been told to spend more on credit cards to build your score? These are not bugs in the system. They are features. Features that make perfect sense once you understand that this score was never designed to measure your financial health. It was designed to measure your value as a borrower to a lender. According to FICO's September 2025 Credit Insights report, the FICO score is used by 90% of top U.S. lenders. There are over 200 specific FICO score versions, different models calibrated for mortgages, auto loans, and credit cards. In the mortgage market alone, tens of millions of loans are evaluated using this methodology every year. The reach of this single algorithm, built from one company's proprietary formula, is without parallel in American financial history. And here is the counterintuitive fact that drives more debate than almost anything else in personal finance. A person who has never borrowed a dollar in their life, who pays cash for everything, carries no debt, and has money in the bank, can have a lower credit score than a person who carries thousands of dollars in revolving credit card debt, as long as that person makes minimum payments on time. This is documented explicitly in published academic research on credit scoring systems, which noted that the system incentivizes accumulation of debts and de-incentivizes people from financing purchases themselves through saving. The system rewards borrowing, not budgeting. The blueprint was written in 1956, and a tool built for lenders became a tool that governs renters, employees, drivers, and homeowners. A formula built for one decision migrated into every decision. Before I show you what this means for your money right now, I want you to see just how far that migration went. Today, a kitchen table somewhere in Middle America. A 34-year-old woman opens her credit card statement. She has been making payments faithfully for 3 years. She checks her balance. The number has barely moved. The minimum payment she made last month, $130, was almost entirely consumed by interest. She paid $22 toward the actual debt. She is not a reckless spender. She is living inside an architecture designed in 1956, and the numbers today are staggering. According to LendingTree's 2026 credit statistics, Americans' total credit card balance reached $1.277 trillion in the fourth quarter of 2025, the highest figure since the Federal Reserve Bank of New York began tracking this data in 1999. The national average credit card interest rate is approximately 23% annually, according to NerdWallet's January 2026 household debt analysis. And 26% of Americans carrying revolving debt make only the minimum payment each month. But here's something important. The FICO score has not stayed in the bank. It has colonized the rest of your life. In many U.S. states, insurance companies use credit-based scores to set your premiums for auto and homeowners insurance. Landlords run credit checks on rental applicants as a matter of routine. Employers, particularly in finance, government contracting, and roles requiring security clearances, may review a version of your credit report before extending a job offer. Utility companies can require larger security deposits from customers with lower scores. This expansion is documented by the Consumer Financial Protection Bureau and referenced in the Federal Trade Commission's Consumer Guidance on Credit Scores. A tool created to assess loan repayment probability for banks in 1956 has become without any single public vote or legislative mandate specifically authorizing this, the de facto passport to American civic and economic life. This is not ancient history. This is this morning's newspaper. And this is not the first time a society built a system of financial scoring that began as a tool for creditors and became something far larger. In ancient Athens, around the 6th century BC, before the reforms of Solon, Athenian citizens who fell into debt could be, and regularly were, enslaved by their creditors. The debt record was the instrument of power. What Solon did, in 594 BC, was to cancel outstanding debts and make it illegal to use a person's body as collateral. He called it the seisartaia, the shaking off of burdens. Historians note that Solon's reforms were not primarily about compassion. They were about preserving the social fabric of Athens, a city where the majority of citizens were permanently indebted to a minority of creditors was, he argued, structurally unstable. Athens survived the crisis by acknowledging that the debt instrument had grown larger than the purpose it was meant to serve. The parallel is not perfect, but the structural question, when does a financial measurement tool become a mechanism of social control, is one that Athens faced in 594 BC, and that the United States is actively debating right now. You now know how the system works. You know where it came from. You know what it measures, and what it was never designed to measure. What you might not yet know is what it costs in human terms when the system fails. And this is where it gets personal. Remember Margaret. Margaret represents the archetype the data consistently describes. A woman in her 30s, steady employment, no bankruptcy, no default. A medical emergency 2 years earlier generated a collections account that appeared on her report. She disputed it. The dispute took months. During that time, she was denied an apartment she could afford, quoted higher rates on a car loan she needed for work, and rejected from a job in financial services that ran a credit check as a condition of employment. The collections item was eventually removed. Her score recovered. But the apartment was gone. The job had been filled. The months of higher interest had cost her real money. The Federal Trade Commission has documented that 1 in 5 Americans has a material error on their credit report, an error significant enough to affect their score. A 2024 study by researchers at the University of Miami and the University of Pittsburgh found that widely used credit scores show significant misclassification of borrowers, particularly those with low scores, and that this misclassification disproportionately affects young, low-income, and minority consumers. The racial dimension of this data is documented, measured, and important to describe precisely. The FICO score does not use race as an input. It never has. That is a documented fact. But according to a 2022 report from the Urban Institute, a nonpartisan research institution, rates of subprime credit scores in majority Black, Hispanic, and Native American communities are at least 1.5 times higher than in majority white communities. A 1996 study found that Black Americans were 3 times as likely as white Americans to have FICO scores below 620. Hispanics were twice as likely. Princeton sociologist Frederick Wary, who studies financial inequality, described the mechanism clearly. The data used in credit scoring models, he noted, is not neutral. It is a mirror of inequalities from the past. By using that historical data, the model amplifies those inequalities forward into the present. This is the real problem with the FICO system. A tool built to be fair ended up carrying the weight of an unequal past, and placing that weight on people who never created it. FICO's own vice president of scoring, Sally Taylor, addressed this in a CNBC interview, acknowledging that credit scores didn't create these socioeconomic disparities. They reflect them. The conversation, she said, should focus on addressing the root cause. This statement reveals the essential nature of the instrument, a mirror. Knowing where a system came from doesn't mean you're stuck inside it. Every generation that has ever faced a financial architecture it did not design has had 2 choices. Wait for the architecture to change, or learn the rules well enough to navigate it effectively. The families who came through the Great Depression didn't wait for the banking system to reform itself. They understood exactly which instruments within the system could protect them, and they used those instruments precisely. Here are 5 things you can do today, right now, that are grounded in a clear-eyed understanding of how this system actually works. First, pull your reports. All 3. Annual credit report. COM is a free, federally mandated source for your credit reports Equifax, Experian, and TransUnion. This is a legal right established by the Fair Credit Reporting Act of 1970. This is a legal right established by the Fair Credit Reporting Act of 1970. 1 in 5 Americans has a material error on their report. You cannot dispute what you haven't seen. Pull all 3 today. Compare them. Look for accounts you don't recognize, balances that are wrong, or late payments that were reported in error. And it is the single most important diagnostic step in understanding your financial position. Second, know your utilization ratio and manage it deliberately. Credit utilization is 30% of your FICO score. It is also the fastest lever you can move without taking on new debt. If your total credit limit across all cards is $10,000 and you carry a $4,000 balance, your utilization is 40%. Paying that down to $2,000, even if it takes several months, moves you from fair territory to good territory in that category alone. The target is below 30% total. Below 10% per individual card is even better. Third, never close your oldest account. 15% of your score is the length of your credit history. The age of your oldest account anchors that calculation. If you have a credit card you opened 10 years ago and never use, do not close it. Put a small recurring charge on it, a streaming subscription, a utility payment, and set it to auto-pay. The account stays active. Your credit age is preserved. Fourth, request a credit limit increase without spending more. Call your credit card issuer and request a credit limit increase. If approved, your available credit rises, and if your balance stays the same, your utilization ratio drops mechanically. This is not debt accumulation. It is using the system's own logic in your favor. One caution: some issuers run a hard inquiry when processing these requests. Ask beforehand whether the review will be a hard or soft inquiry. Fifth, if you find an error, dispute it in writing, not online. You have the legal right under the Fair Credit Reporting Act to dispute errors, and the Bureau is required to investigate within 30 days. Dispute by certified mail, with documentation. Online dispute portals are convenient for the bureaus but create a thinner paper trail for you. A written dispute with documentation is harder to dismiss and easier to escalate if the bureau fails to correct the error. All of them are grounded in the documented mechanics of the system. Financial freedom, real financial freedom, starts with knowing the rules of the game you're already playing. Remember that apartment in San Rafael? That folding table? That legal pad covered in numbers? Bill Fair and Earl Isaac were not villains. They were engineers who looked at a genuinely broken system, one that denied credit based on race, on gender, on a banker's mood, and tried to replace it with something rational, something mathematical. What they built worked, for the purpose it was designed for. The problem is what happened next. A tool built for lenders became a tool that governs renters, employees, drivers, and homeowners. A formula built for one decision migrated into every decision. And it did so without debate, without a vote, and without most people ever being told the rules. The blueprint was written in 1956. We are living in it. If you enjoy this kind of hidden financial story, this channel exists precisely for that. Subscribe now so you don't miss any new content. Here is what I want to know. Now that you understand that this score was built to measure your value to lenders, not your actual financial health, what is the one thing you would change about how you've been managing your credit? Tell me in the comments. I read everyone.